Hello everyone, welcome to Accounting Simplified. So today we will be elaborating further what we studied in the previous video lecture. So what we studied therein, we just remembered one term, one phrase, dead silo. So what is it? Do you remember? DEAD CILO. So herein we can show it in a statement on two sides. So D represents debits, C represents credits. E is for expenses, A is for assets, D is for drawings, I income, L liabilities which we are to pay, our payables, O is for honors, equity, that is capital. So expenses, assets and drawings are always on the debit, and income, liability and capital, honors, equity is always on the credit. So what it tells is that every account is having two sides. Debit is always on the left side, we show it with DR abbreviation, and credit is always on the right side. So you may prepare any account, cash account, purchase account, machinery account, land account, capital account. So the accounts format is this. It is a T-shaped statement just like this that we are learning in a simple way. So it is also a T-shaped statement having two sides. Debit is always on the left side, credit is always on the right side. Now we are to understand why we are writing these here, and income, liabilities and capital on the credit side. Basically what is debit and credit? Debit and credit are the tools to record the changes in these accounts. That is, if any change is happening in the expense account, asset account, drawing account or liabilities, then this change is recorded through debit and credit. So debit and credit is just a tool to record the change. So when we are to record the change, one may question that change can be on any side. Change can be plus, change can be minus. Like your asset, you may buy it, so your asset is increasing, plus. You may sell the asset, your asset is reducing, negative. So a change can be any. So why only these? This is just for our remembrance. What is this? This says that these are the positives. While making journal entries, we are to debit some accounts and credit some accounts. So to remember that debit and credit, this basic simple rule is follow this pattern. So when these accounts are showing increase, expense, assets, drawings, when they show increase, they are debited. And when income, liability or capital shows increase, these are credited. Okay, so these are just to show the positives. It also means that if there is decline in these, then it will be credited. So if your asset is increasing, it is debited, but if your asset is decreasing, it is credited. So while making entry, you can remember this phrase and you will never falter like what to debit and what to credit. Now our double entry system, which is the most you can say scientific method of recording the information correctly, it says that debit will always be equal to credit. That is, in a journal entry, how many accounts we might be debiting or crediting, but the total amount debited will always be equal to total amount credited. So a debit will always be equal to credit. So when we pass entry, debit and credit is equal. When we compile the accounts, we make the two things equal to balance the account. Then when we put the balances in a trial balance, again these are equal. So trial balance and all accounting, that we will study later on, but right now just remember that debit will always be equal to credit. So what is the significance of this? Like when we are making entry, we will do this in detail. Like when you are having any expenses, these are debited, right? Increase in expense, debit. Now if there is a decline, now someone may say that how can there be a decline in expense? It can be just because of a wrong entry, like you paid rent of say 15 months, 15,000. So you wrote rent expense 15,000. Increase in the expense, debit kar diya, you did debit it, so that is 15,000. But then at the end you know that expense for the year is only 12,000. So you are to reduce that 3,000. So that will be credited. Now asset, when you buy asset, it is added. So this is increase. So assets increase, plus will be debited and decrease minus will be credited. So if you buy, say in simple terms, you buy furniture. So by paying cash. So you have got furniture, you paid cash. So furniture being an asset, increase is debited. Cash being an asset again, but it is now going out. It is reducing. So it will be credited. So in any account, say I am preparing asset account. Any name. Take any name of the account. So debit will be recording the positives and credit is for the negatives. But for these income, liability and capital, the rule is reverse. So therein the positives are credit and my negatives are debit. So debit and credit are tools, and this phrase will tell us what to debit and what to credit. So in any case, debit will always be equal to credit, right? So we are to remember this phrase to understand debits and credits. If you get confused like what to debit and what to credit, then just remember this rule. Now this phrase is not only important for understanding debits and credits, but it is also important for the final statements. Like at the end, accounting is usually done on yearly basis. So at the end, incomes and expenses are compared together to find out the profit or loss. That is done through a statement of trading and profit and loss account. This is also called income statement, right? So at the end of the year, these accounts are matched against each other and we calculate income. That may be a profit. If your income is more, you get profit. This is very logical, right? And if you have more of expenses, then the difference is your loss. So this income statement, which is a compilation of expenses and incomes, will tell us profit or loss which belongs to owner. In normal businesses, this is directly given to owner, but in case of companies, this is kept separate in the form of reserve and surplus. So that is given later on in the form of dividend, etc. So you may keep it as retained earning, as surplus, or you may give this in form of dividend in case of companies, but in case of sole proprietors and partnership, directly profit is distributed among the owners. Otherwise we get a different name like plus surplus. So that will be recorded alongside surplus. But these two belong to owner, right? So what we find is that these two will be compiled. So this phrase dead silo not only tells us about the accounting of the information, that is plus or minus, but it is also giving us insight into the components of trading and profit and loss account. Next statement, balance sheet is also shown through this. So what is drawing? Drawing is the amounts withdrawn by the owner. So this is a kind of negative of capital. These are two opposites. So whenever an owner puts in money, it is added in the capital. Whenever he draws something for his personal use, it is added in the drawings. So at the end, this drawing again is cancelled against the capital to find out net owner's equity or owner's capital. So owner's equity consists of his capital minus of drawing, because these two are having opposite nature, debit and credit. So this is deducted, profit is added, loss is deducted. So this is his net equity. So when you present this, we get accounting equation. So what is our accounting equation? This will help you a lot later on when you are passing entries. It is assets is equal to liabilities plus owner's equity, which is also referred as capital. So some people call it A is equal to L plus E. Some people call it A is equal to L plus C. And what is this equity here? It is his capital, total capital that he has invested, plus profit minus of loss, because this also belongs to him, minus drawing. These two are opposite of each other. So when drawing is adjusted, it is subtracted. So we get rid of this by subtracting it from here. So what we are left with is assets is equal to, because this should be equal, assets is equal to liabilities plus capital. This we have cancelled and we have adjusted it in capital. So our phrase is left with only these three things. So since debit should always be equal to credit, so asset will always be equal to liabilities plus equity. So in general, this is. So this is represented through the balance sheet, which is another final statement. So at the end of the year, a business prepares two statements. Expenses and incomes are cancelled and income statement shows us profit or loss, and balance sheet shows this accounting equation, assets is equal to liability plus capital. This is a presentation of balance sheet. This is the equation and this will always hold true, because we are adjusting the remaining things in the capital. Okay, these two are adjusted, net effect is added and subtracted in the capital, drawing is deducted from the capital, so we are left with only assets on one side, liability plus net capital on the other side. So asset will always be equal to liabilities plus capital. So debit will always be equal to credit. So when we pass the entries using these rules, we will be getting the correct answers, because in any question at the end the balance sheet should always be equal. That is, this accounting equation should hold true in all circumstances. So I hope this is clear to you. So next time we'll study further like entries, etc. Thank you.